Right now, as of 11:03 a.m. Eastern Time on November 7, 2025, shares of BioKey International, ticker BKYI, are trading at $1.1499 per share. That is a staggering intraday move, up 51.5 cents, an explosion of 81.17%. The volume is an almost unbelievable 314 million shares, a figure that dwarfs its usual activity, signaling an event of massive significance. This is not a drill, and it's not a glitch on your Robinhood app. Now, the immediate expectation for a stock this small, which just yesterday closed around 63 cents, is that this is some kind of coordinated, baseless, social media-driven pump. We see this all the time with microcaps. The expectation is that there is no substance, that this is just noise, and that anyone buying at these levels is simply chasing a phantom. That is the expectation. The reality, however, which just hit the wires this morning, is something else entirely. BioKey just announced it has secured a major, significant new deployment contract with a major defense sector security organization in the Middle East. This isn't a minor partnership or a hopeful press release. This is a signed deal, described by the company as one of its largest security sector deployments in that region to date. This single piece of news completely shatters the long-held expectation that BKYI was just another struggling technology company lost in the noise of the NASDAQ. Let's establish the common ground, the perception of BKYI as of yesterday. This was a stock firmly in the microcap doldrums. It was trading well below $1, staring down a NASDAQ non-compliance notice. It's a company with a history of unprofitability and shareholder dilution, a name that would never appear in a large Fidelity mutual fund or be a core holding in a Schwab Intelligent Portfolios account. It's the kind of high-risk security that only specific traders, perhaps using platforms like Interactive Brokers for its advanced tools, or retail speculators doing self-investing on SoFi Invest, would even look at. Just on October 27th, the company announced a warrant inducement transaction to raise $3.1 million, getting investors to exercise their warrants at a reduced price of $1.02 per share. This was a move to get needed cash in the door. The expectation was, frankly, one of a company just trying to keep the lights on. But today's reality check is profound. That $1.02 warrant price from just 2 weeks ago now looks like a floor rather than a ceiling. The stock has gapped up, blown past that level, and is holding, all because this new contract isn't just about revenue, it's about validation. The customer, which is remaining anonymous for security reasons, is in the defense sector. This is one of the most demanding, high-stakes security environments in the world. They aren't buying a product based on a slick marketing deck, they are buying it because it meets a critical, non-negotiable security need. This validates BioKey's identity-bound biometric technology in a way that no earnings report ever could. The contract is specifically for biometric and multi-factor authentication, and here is the key differentiator. It's for phoneless and tokenless environments. This is BioKey's whole thesis, that true security shouldn't rely on something you have, like a phone or a token, but on something you are, your biometrics. For a high-security defense organization, not wanting to rely on vulnerable mobile devices makes perfect sense. This win suggests their technology has a real-world, high-stakes application that a lot of the market had clearly written off. This news also illuminates the importance of a strategic partnership BioKey recently forged with Cloud Distribution, a Saudi-based value-added distributor. This deal wasn't just a handshake, it was the mechanism that gave BioKey the local expertise and in-country capability to secure this exact kind of contract. This is the nuts and bolts of how a small U.S. company can actually penetrate a complex foreign market. This isn't just a lucky break, it's the result of a deliberate, strategic move that is now quite literally paying off. The sheer trading volume today tells you the market is scrambling to reevaluate what this company is worth. This isn't just a few thousand shares being swapped on the Robinhood stock trading platform. This is a fundamental repricing, with hundreds of millions of shares changing hands. The stock even gapped open at $0.94, spiked as high as $1.38, and has been consolidating around the $1.15 level. This is a battlefield. The 52-week low was just 61 cents. The 52-week high is $3.68. Today's move has completely reset the trading range and put that old high back into the conversation for the first time in a long time. This is the kind of volatility you might expect from Tesla stock on a wild earnings day, not from a sub-10 million market cap biometrics firm, but here we are. This is the reality of online investing. Information moves fast, and the market's reaction is immediate and, in this case, ferocious. So let's take a step back. What does BKYI International actually do? For those who are just now discovering this company, BKYI is not a new startup. It's been around. The company is in the Identity and Access Management (IAM) space. Its core products like PortalGuard are designed to replace the password. We all know passwords are a weak link. We all know multi-factor authentication, like getting a text message, is the current standard. BKYI's argument is that even that isn't good enough. Phones can be stolen, SIMs can be swapped. Their solution, Identity-Bound Biometrics, is built on the idea of using your unique fingerprint or other biometric data managed through their platform to prove you are who you say you are. They offer this as a software-as-a-service (SaaS) or on-premise solution. They also sell the hardware like their small USB fingerprint scanners. The business model is a mix of software licenses, recurring SaaS revenue, and hardware sales. Historically, the problem hasn't been the technology, it's been scaling the business and achieving profitability. The company's financials have been difficult. Their last 10Q filing from August for the period ending June 30, 2025, showed a company that was still burning cash, with revenue that wasn't growing fast enough to cover its operational costs. This is why the stock was languishing, and why it required that warrant transaction last month to raise capital. This is the central tension of the BKYI story right now. The expectation, based on its financial history, is one of high risk and potential failure. The reality, based on today's news, is one of elite technological validation and a new, massive commercial opportunity. The question for anyone looking at this stock on their Fidelity trading platform or considering it for their Fidelity IRA, which would be a very aggressive move, is which of these two narratives will win. Does this one contract, which is specific financial value has not been disclosed, fundamentally change the company's financial trajectory? Or is it a one-and-done pop, a single great win that won't be enough to reverse the company's long-term cash burn problem? This is where the real analysis comes in, and it's what separates basic online investment from a deeper understanding of the market. This stock is not, and I repeat, not, in the same category as Apple stock or Nvidia stock. Those are blue-chip megacaps. BKYI is a high-stakes bet on a turnaround. It's the kind of holding you manage actively, not one you put in an intelligent portfolios and ignore. So, let's talk about the future outlook. The bull case is clear. This is the foot in the door. This isn't just a contract, it's a beachhead in the entire Middle East defense and government sector. Having a major anonymous defense organization as a reference customer is the ultimate sales tool. This could lead to more contracts, both from this client and from others in the region. The partnership with cloud distribution is now proven to be effective, which de-risks their international expansion model. The bulls will argue that the $1.02 warrant exercise price set a new money cost basis, and as long as the stock stays above this, the momentum is real. They will look at the tiny market cap. Even after this 80% pop, the market cap is only around $8.7 million, and argue that if this contract signals a path to, say, $10 or $20 million in new recurring revenue, the stock is still incredibly cheap. The bear case is just as clear and must be respected. We don't know the size of this deal. Is it $500,000 or $5 million? One is a nice win, the other could change the company's entire financial picture. Until those details are clearer, this is all just speculation on the significance. The company is still unprofitable, it still faces the challenge of scaling, and let's not forget the recent dilution. A company that just raised capital via warrants may need to do so again if this new revenue isn't large enough or fast enough to get them to cash flow positive. Bears will argue this is a classic microcap story, a single piece of good news that provides a temporary exit for trapped shareholders and early investors, but that ultimately the long-term financial problems remain. They will point out that the stock is still trading under its 52-week high and that the path back to a stable, profitable enterprise is long. Anyone using an individual brokerage account to trade this needs to be aware of both sides. This is a binary event